Hey everybody, welcome to our YouTube channel. My name is Glenn Tompkins, Senior Instructor here at VectorVest. I'm wearing a blue shirt. Well, that means this is an educational video, right? So we're getting to the latter part of the series, Stock Market for Beginners. And these last couple of videos are going to pretty much hopefully bring it all home for you. We've talked a lot about the beginning parts of investing, what it's all about, how much money you need, everything. I tried to cover every aspect of the beginner investing in the market. And today, we're going to talk about the difference between dividend investing and capital gains, the differences between the two. Which is better? Well, the answer may surprise you. So if you're ready to go into it, you sit right there. Hey everybody, once again, my name is Glenn Tompkins, Senior Instructor here at VectorVest. Love bringing this recording or this series for the stock market for beginners. And I think that it's a video series that will hold through time, whether you watch it now or you watch it sometime in the future. Don't forget to share this video with someone who's interested in learning about the stock market. I think it puts a lot of great perspective into what the stock market is all about. If you're brand new to the channel, folks, don't forget to hit the subscribe button. That's how we grow our channel. If you like the content, don't forget to smash that like button. And we look forward to continue to bring out good quality videos for you on our YouTube channel. So we're talking about dividend investing, which is passive income. What is passive income? We talked about it in a prior video. Passive income is just money that comes into your portfolio. You don't have to actively do anything. As long as you're in a stock that pays a dividend every quarter, that money just goes into your account. Or capital gains. Well, that's when you're actively trading if you're short term, or you're in good quality stocks long term that grow in value. These are stocks that continue to go up in price. Whether you're long term, whether you're mid-term, looking at swing trading, holding stocks from a couple of days to a couple of weeks, or you're looking at long-term good quality stocks, all of that is capital gains. And the whole idea is to grow your portfolio from here up to here so that when you retire, you've got all of that money to hopefully put you in a better spot for financial freedom. What is financial freedom? It means I got all the money in the world. No, not quite. Financial freedom is being able to live your life without having to depend on anyone to help you to do anything, to live a lifestyle that you feel comfortable with, to still continue to pay your bills and not need anybody else's assistance to help you. That's financial freedom. And your goal, especially if you're brand new to investing in your market, is to take your portfolio from where it is now, no matter where it is now, up to a point where when you do retire, you're good to go. That's what financial freedom is all about. And that's why we've gone through this whole video series to get you to that point by understanding what it's all about to invest in the stock market. So the answer to your question, I'm going to answer the question, which is better, dividend investing or capital gains or capital appreciation? And the answer is a combination of the both. I don't want you to just sit back and look at just dividend investing and chasing after big dividends. And that, my friends, is or could be the downfall of your portfolio. Just chasing dividend yield is not what you want to have happen. Just because a company says it's got the ability to pay out a big yield doesn't mean that it can sustain that yield. There's a couple of things that you need to look for and not fall into that trap. One, is the dividend a safe dividend? Two, does the company make enough money to sustain that dividend? A lot of companies out there that tout about big dividend yields. Oh, we're going to pay, our dividends. We're going to give a percentage or a yield of a high number, and people go after those stocks, but the company doesn't make enough money to cover that dividend, which gets back to you. And the dividend is a reward for being a part of the company. It's the company's way to give back to the investors. We're going to give you a piece of the profits. Well, if they're not making money, they can't make the profits and they can't continue to pay out the dividend. And therein lies the problem. A lot of people get caught chasing the dividend yield. So you've got to have a tool whether it's VectorVest or whatever else, to tell you if the dividend is sustainable. We have an indicator in the VectorVest system called Dividend Safety, which on a scale between 0 and 100 tells you just how safe that dividend is. But if you don't have VectorVest, look at the earnings yield on a company. Is the earnings yield higher than the dividend yield? And if the dividend yield is higher than the earnings yield, be careful, all right? You want to make sure that the earnings yield is at least 2 times what the dividend yield is. That company is definitely making enough money to cover that dividend. So the answer to the question is which is better is a combination of the both. The average dividend return on the stock is sitting about 2%, all right? So it's not a lot to grow your portfolio, but it is added passive income, where right now on average the S&P 500 makes about 8% a year, and it's just averaging out. So you know something, I did this. I went into the VectorVest system and I ran the S&P 100 right here. I did the S&P 100 over the last year, 2021 to 2022. You may be watching this video at a later date, at a future date. So it is what it is, but I want you just to understand where we are right now. I looked at the top 100 or S&P 100 stocks from 2/16/21 to 2/15/2022 as of right now, and they're up 14.84%. Now, a lot of you will sit back and go, holy smokes, I'm not making 14.84%. Well, it's true, but this is if you were able to buy at least one share of every stock in the S&P 500, S&P 100, which is probably a lot of money. One share, you'd be up about 14 and almost 15% over the last year. Remember, I said on average, though, the S&P 500, I only looked at the 100, the S&P 500 returns about 8% a year on average. There's some years that are better, some years that are worse, some years that are much better, some years that are much worse, but on average, about 8% a year. And a lot of you are probably saying, well, I'm not even making 8% a year. Well, then that's all comes down to your trading plan. You need to know what to buy, and when to sell. And that's important. We talked about that as well. Having a trading plan that fits you, because every investor invests a little differently. All right, so when we look at this, again, just over the last year, about 14.84%, the market, or the S&P 500, in and of itself was up about 13.5%. So not only did we do well, 14.84%, but we outperformed the S&P 500. This is the S&P 100. So now, a little note to self. If you're brand new investing in the stock market, S&P, whether 100 or 500 stocks, is a good way to start to find the stocks to invest in. These are good, solid companies and a great way to get off the ground and starting to find stocks to get involved with. All right, so I'm going to take this off and I'm going to stream this back into today, which is February 15, 2022. Again, you may be watching this in the future, and that's fine. I just want you to understand what was going on at the time of recording the video. Now, let's talk about this, dividends. A lot of these companies in the S&P 100 do have or do pay dividends, nice dividends as well. Now, remember I told you that we had an indicator that goes to show you how safe the dividend is? Here it is, Dividend Safety, DS. Now, it's cast on a scale between 0 and 99. In order for a dividend to be considered safe, you want that dividend safety to be above the value of 50. So we look at ConocoPhillips, Exxon, Alphabet, American Express. Notice that every single one of these do pay a dividend. And the dividend safeties, for the most part, for the ones that do pay a dividend, are above 50. These are safe dividends. Now, here's the dividend yields, 3%. 4.5% on Mobil, that's a good one. 4% on Chevron, 3% on Bristol Myers. But also notice that the earnings yields are at least 2 times or close to that higher than the dividend yields. That adds to that dividend safety. So if you don't have a software or a system like VectorVest, you want to make sure that the earnings yield definitely is at least 2 times or thereabouts higher than the dividend yield to make sure that the company can continue to pay the dividend or grow the dividend. If that dividend safety is below 50, the ones that are zero are the ones that do not pay dividends. Here's one, Dow Inc. It's got a dividend safety of 46. It's below. I would be careful with that. Look at the dividend yield of 4.5. Now, the earnings yield is more than 2 times the dividend yield, but there's other indicators or other factors that come into play to calculate dividend safety. And when I see a dividend safety below the value of 50, I at least keep my eye on that from a dividend perspective. Now, if you want to find good dividend-paying stocks to incorporate in your portfolio, we have a watch list in the Viewers tab called Dividend Payers, but we have portfolios or watch lists called DRIP, Dividend Reinvestment Program. And stocks that have grown their dividends 10 to 24 years, 25 plus years, 5 to 9 years. These are stocks that you can take advantage of that are great dividend quality, good quality dividend stocks. So again, to wrap this all up, the combination of the two is where you want to be. And understanding that just because a company has a good dividend yield doesn't always mean that it's the best stock to go after from a dividend perspective. You need to make sure that the company makes enough money to cover the dividend yield. But if you have VectorVest, you do have the ability to have an indicator called Dividend Safety, which pretty much puts right to the forefront the companies that have the highest probability of either maintaining or growing their dividends. Folks, it's been a pleasure to be bringing this video series to you. We've got one more video left. If you like this series, by all means, please don't forget to hit the like button down below, hit the subscribe button, so that you can view all of the other content that we put out for you. We pride ourselves on putting out great content, and we hope that you like it. Folks, this video is over, and until the next time, see ya.